Both state-owned and private lenders put up a strong show in the July-September quarter. 12 public sector banks reported an average of 50% year-on-year growth in net profit at 25,685 crore rupees. The jump came primarily on the back of a steady rise in net interest income and lower provisions. The second quarter results posted by PSBs were also supported by strong credit growth and expansion of net interest margins. Experts say while a moderation in net interest margins may occur going forward, healthy profitability is likely to continue. Asset quality also improved. At the end of September, state-owned lenders saw their gross non-performing assets decline 15.8% year-on-year to 4.98 trillion rupees. Their net NPAs were also down 13% year-on-year to 1.28 trillion rupees. However, hardening yields have had an impact on treasury income on a year-on-year basis, and experts say the treasury performance may stay muted. Meanwhile, private lenders collectively clocked a profit of 33,165 crore rupees, which was around a 67% jump year-on-year. The profit figures soared on the back of higher net interest income and robust loan growth. There was also a lag on the part of the banks in passing off increased rates of interest to depositors while pushing the lending rates higher, following the increase in the repo rate by 190 basis points. This translated into an impressive growth in the margins of these lenders. Asset quality also improved significantly as both gross non-performing assets and net NPAs declined year-on-year. Staying broadly in line with the credit growth, most private banks saw double-digit growth in their portfolios. Against this backdrop, there is now a sense of optimism surrounding the Indian banking sector. Business Standard consulting editor Tamal Bandyopadhyay says there is definitely broad optimism around India's banking sector, and the most important contributing factor is the quality of assets. Having gone through pain after the asset quality review, the sector has come out clean. Bandyopadhyay adds that on the asset side, the balance sheets are looking pretty good. According to him, the recoveries and lower slippages are also adding to the optimism. Provisioning for bad assets, which had been eating away at the profits of lenders, has come down dramatically since the June quarter. For most banks, the provision coverage ratio is very high. Overall, the sector is quite healthy at present. Others are also sanguine about the sector.
We now realize that there is some kind of a, compared to the other global countries or the emerging countries, you find ourselves sort of in a better economic growth condition. This leads to two things. One is it leads to better recovery, it leads to optimism. And of course, according to the governor's last statement, there is a better capacity utilization as well. The second important factor is the quality of assets. The quality is improved for the existing assets as well as, I suppose, for the new assets which the banking sector is adding. The quality of, let's say, the credit of the assets is really improved a lot. The third is the digitalization of the digitization. A similar huge amount of challenge that was thrown up during the COVID. Indian banking sector faced it very well. Be it private sector, be it public sector. Perhaps the last and the fourth one is emergence of a much stronger public sector banking also after the consolidation, after correcting the balance sheets.
There are areas of concern too. A State Bank of India research report has said that banks are not adequately pricing in credit risk, even as liquidity remains significantly downsized and credit demand is at decadal highs. Earlier this year, RBI Governor Shaktikanta Das had said that banks could not perennially rely on the central bank's money to support credit offtake, adding that they would have to mobilize their own funds and resources. The latest RBI data show that as on the 21st of October, bank credit growth was at almost 18% year-on-year, while deposit growth lagged far behind at below 10%. This raises questions about how sustainable this recovery will prove to be in the coming quarters.
Net interest margin will definitely have to come down because, as you have seen, the banks which have been, most banks, I would say, have been recording about 20% credit growth, which you yourself said is a decadal high, even for the industry, the entire industry. But where is the deposit growth? Deposit growth is half of it. Some of the banks is even 1/3 of credit growth. Now, to what extent you can support this credit growth? You have your capital, and then you can borrow short term, which they are through CPs and CDs, which many of the banks done. But at the end of the day, you need to raise your deposit rates. And once you raise your deposit rates, which most banks have been doing, but they have to raise it more. So certainly the NIM will be affected.
Bandyopadhyay also says that we need to be watchful of any irrational exuberance in the credit segment, adding that the underwriting has not been immaculate. According to him, there is a worry that certain state undertakings that probably believe that they are the proxy sovereign may be giving loans without the right kind of underwriting. Thus, he warns of the possibility of some banks ending up with higher NPA levels once again.
So there's a hard mentality which we had seen the last decade, and that led to Reserve Bank of India's massive cleanup drive in the form of asset quality review. Probably we may see this again, maybe 4 quarters, 6 quarters down the line. And as they say, when the tide goes out, I mean, who are swimming naked, you will find them. So some of the banks may have to pay the price.
It is clear that banks will have to aggressively raise their deposits in the days ahead and garner durable liquidity to meet the rising credit demand. At the same time, they must ensure that underwriting remains as credible as possible.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.